Let's talk budgeting. Founders, bring your spreadsheets. Marcus Rien breaks down a 3-meeting budget process, smarter incentives, and when to call in a fractional CFO to sharpen your plan.
A lot of people are very optimistic with AI. What some are realizing is that AI isn't the end all be all fix. It definitely facilitates and helps jobs, but at the end of the day, it still requires a human to review it, make sure that AI is operating as intended. I think that kind of awareness that, as an entrepreneur, we want to do everything and see everything, but there's people who are better suited to do certain things. It's just a matter of, getting that right match in place.
We're back again with Marcus Rien. You know this guy. You've heard his voice. You've seen his face. We're going to talk about budgeting, getting you guys ready for next year. We're recording this in August, and yes, you should already be thinking about and taking actions to budget for next year. Are you? We'll find out. What should a founder or leadership team be thinking about as they head into the fall or budgeting season?
I think it's important to look at where you've come this year. If you've had a budget process in this year, evaluate how your actuals are looking against your budget. That's a good first place to start. If there were significant deviations, those are definitely bullet points that you want to highlight for your next budgeting season so you can address whether or not those significant variations will happen again, or if it was just a one-off year. Another thing you want to look at is whether the company has had major shifts in sales activity, significant turnover, or significant cost overruns on whether you're producing a product or a service. That kind of awareness helps you start to think about what next year's budgets could look like from a baseline perspective, and then you can layer on growth from that.
Why is collaboration and accountability important from the different team leaders in the budgeting process?
Yeah, you've got different team leaders who know their area better than other team leaders and potentially better than you, depending on the size of the company. They're going to be closer and more intimate with the activities in their department, and they're going to know better with their professional judgment on whether or not you need to spend more money, renegotiate contracts, or potentially completely shift a sales strategy. And I think if you, as a leader, can give them ownership and accountability, KPIs for a budgeting season, they'll have a greater sense of pride to execute on that budget and will be more aware of deviations from their budget throughout a year and can give the better qualitative assessment of performance for those quantitative budget numbers that were set.
Let's talk about goal setting. How should leaders be looking at their current year results when they're setting their goals for next year?
Yeah, I think you want to look at your budget versus actual performance year to date. We're sitting here in August, so by now you've got 7 months under the belt. You've got a pretty good idea of how the budgeting process went last year. Not just the process, but how accurate were you with the numbers that you projected you would spend or the sales team would produce. So with that baseline, if you're a founder or a business leader, did the company make money with that process? That's a good first step. Second step is, how far did owners of budgets deviate from them? And thirdly, you can have conversations with those leaders to learn more about why budgets might have missed, and that'll give you a good foundation to start discussions for next year, looking at sales targets, looking at costs spent by department for next year, whether you're going to be adding FTE, whether you're going to be shifting service providers, or whether you're looking to potentially look at a new product or service category that could consume some resources or time.
What are the risks if somebody sandbags their goals for next year? So if a leader says, "Yeah, we can only do 2% growth," how can underestimating your goal for the next year impact the rest of the org
And when you say
financially?
sandbagging, are you talking about someone who says, I'm going to spend $10,000 next year and I probably will only need 3,000, but I'm just going to create that capacity?
Both. So someone who says that they need more resources than they know they're going to use, and somebody who says that they're going to produce way less than they know they're capable of doing. Like, yeah, we can only sell 1,000 when they know they're probably going to sell 2,000.
Sure. Well, those are two different kind of ways to think about budgeting. One is on the sales side, so revenue generation, and the one's on the
Hmm.
cost spend. So let's start with the cost spend. I think you definitely want to look at the why behind the numbers. So having an itemized budget is helpful. You're going to estimate, obviously, but it should be relatively consistent with your prior year spend and year over year as a percentage of overall cost spend or some other metric to just get a better awareness that they're giving you a realistic spend number and asking good questions instead of just approving the budget. I know that there are founders out there and there are business owners out there who are nervous that staff might ask for more than they need, and there is that common risk or business practice where if people are given a $12,000 budget for a year that they get to December and they've only used six of it, that they're going to spend another six in December just because they don't want to lose their budget for next year. I think it's important to bring awareness to our organization that that's not a good practice, and that is kind of discovered that there are consequences to that. More so just encouraging people that just because you didn't spend your budget, you might still get the same budget next year or even higher if it can be justified. And you might even receive incentive for coming in under budget for the year. It's in retrospect, you might say, okay, well, then that person's going to say, I need 12,000. They only need, $3,000. That again gets to the why, asking good questions with why they've come up with a line item on their budget to spend it, and just letting them know that, it's okay to be wrong. These are estimates, but to the best of the team's ability, you want to get to a good estimate of cost spend for the year. On the sales side, as far as someone who might say, I don't think we're going to sell 1,000 units of something next year. We might sell 500. If you have a bonus program that incentivizes them to outperform that 500 number, well, now they're going to obviously be incentivized to reduce that as much as possible. So you might want to think about your incentive program and what really motivates someone to put together a budget. And I think as a business leader, it's important to just ask good penetrating questions with a sense of curiosity, not necessarily a sense of, punitiveness where you're questioning maybe their ethics or their character, but really just coming at it from a perspective of you really just want to understand more about the business and what they're working on so that you can support them longer term.
I've also been a part of sales I'm from the revenue generating side of organizations. I've been a part of companies where top down excitement for the following year has clouded judgment and just no numbers are real. They'll just say, hey, we're going to grow by 25% next year. And that's pushed down on the org without asking those questions. How, why is this realistic? What's the danger of just doing what they call a swag number, where you set a goal that's not even based in reality?
Swag, meaning scientific wild ass guess.
Yes.
That's definitely risky. You can sit there from a top down approach and say, we're going to grow by 25% this year, and say, okay, every other cost center can go up by 25%. That doesn't necessarily need to be the case. And quite frankly, in some areas, you may need to spend more than that 25% to get that 25% of revenue. But depending on your business model, that additional, even if you have to go above 25% spend to get that 20% growth in the next year, it may yield a multiple of revenues in the future years. So it's worth going and spending more next year. You've got to have a very pragmatic and realistic approach to a budget, especially when you're starting with revenue, because that's the top of the P&L. So if you're going to say we're going to grow by 25% next year, you have to work in a collaborative environment to come up with a cost structure that's going to support that growth. You can't operate in a silo by yourself and just say we're going to grow by 25% and everyone's budget's going to be the same as last year. That's not a thoughtful approach and could put a lot of strain and concern on a lot of people for the next 12 months. And that's just not something that you want to risk with your business. So it's great to be optimistic with your sales forecast and your revenue targets for next year. but you definitely want to include other people in the process. In EOS speak, I like to say that you've got three horses: the sales leader, the operations leader, and then the finance and administrative leader. If you're saying your sales leader is going to be 25% higher next year in terms of revenue versus this year, it's hard to imagine that that's going to be without additional resources or costs from an operations team. So, at least from that perspective, you'll want to make sure that those two are collaborating to say, what's it going to take from the
Mhm.
operations side to support that growth, not just getting the business in the door, but also then delivering on that service or that product over time. And then obviously those numbers get fed into the third horse or the finance administrative horse so that they can report back on the performance over the next year.
And even the sales team growing by, say, oh, we're going to grow sales by 25%, they're probably going to need more marketing spend. They're probably going to need maybe another rep or something else. It's not just going to magically sell more with the same amount of people, even with AI.
Yeah, and
True or false?
we could get into a wormhole of an AI discussion here. Not to say that it's a buzzword, but a lot of people are very optimistic with AI. What people some are realizing is that AI isn't the end all be all fix. It definitely facilitates and helps jobs, but at the end of the day, it still requires a human to review it, to do some of the work and make sure that AI is operating as intended. So AI is great for a lot of things, and it can shorten up a lot of the mundane tasks that we were doing so that we can spend more time on higher value tasks. But sometimes it's not a perfect relationship where AI will do 80% of the effort and you'll do the 20%. Sometimes it's a one-to-one relationship where it's just improving your outcome, but you're still spending the same amount of time on it. For example, if I'm going to write an email, I wrote that email. I know what it says, and I know what's good, and I know what tone it carries. But if I ask ChatGPT to write an email for me, I have to read that email. I have to spend the
Mhm.
time thinking about whether or not that's the correct, tone I want to share with this customer. And then I have to go back and write prompts again. So I'm going to be more effective utilizing AI in that scenario because it's going to be able to produce a better product with probably less grammatical errors. But it may still take just as much time for that same email to go out the door.
So, as folks are budgeting and it's the fall, if you don't already have an AI system in place or something that your team's using in AI and you know from the past few months this is how much more effective it's making each team member, they probably shouldn't say, okay, well in 2026 we're going to need 25% fewer people because AI is going to solve it. Like unless they already have proof in the pudding of how much more effective their team's going to be, they probably shouldn't just swag that into the budget. True or false?
Yeah, I would say you definitely need to have that conversation with leaders. How is AI improving your efficiency, whether it's closing new business or the amount of effort you're putting into closing the business. And as a decision maker in a company, again, you don't want to operate in a silo and just assume that there's that expression, if you assume, you might be making an ass out of you and me. And at the end of the day, it's your team that's going to get hurt by that because as a business leader, it's hard to take fault for it. Although we always should. In reality, it's hard for people to do that. So set both yourself and your team members up for success and have that conversation about how AI is improving it in a realistic way, and make sure it's a safe space for them to be honest with how it's impacting their job. Because again, if you want to approach this from a people first and business second approach, such that they feel like they're comfortable giving you the information, truly the accurate information you need to make the best decisions for them and the company.
Are there any habits that you've seen in your career that separate great budgeting from budgeting that companies do?
You gotta have a system and a process. Whatever tool you're using, it's got to be systematic and do the work, put in the time. It sounds ridiculous, but Excel is just in this case, magical. The ability for you to adapt from company to company, how to set it up is important. Having your chart of accounts in there from your accounting system, very, very important to how you're going to track that over time. So I mean, that's just an important start. Plus, it'll make it easy for your finance team to integrate the budget numbers into your accounting system so you can get accurate and correct reporting in an efficient way throughout the year. But I'm a fan of giving a Excel tab that's structured the same way to different leaders, and one that is set up for them to do as little work as possible in Excel, but still be able to get the numbers in a format that's easily integratable into a budget. And, you can have 3 meetings set up with your team over a budgeting process to reevaluate the overall impact of their budget on the company, and then have one-off conversations with each department as well, so that leaders are getting a full picture of where their budget is for the department and the company, and then how you're working with them to refine it, in the duration of those 3 meetings. The first one is definitely going to be, what could you spend money on next year if you're in a cost center? Assuming that you had just, a really, not necessarily an open checkbook, but if you were given the chance to spend money that would benefit the company, what would you spend it on? On the sales side is, how aggressive could you be? What do you think is out there? Can we just really blow the top off this thing next year? What does that look like? And then, you could put those numbers together in the file, bring it to the leadership team and say, okay, this is our blow the top off the company. This is like, we're just going to go nuts. This is what we could do. And then you'll get the sense like, this could be wild numbers, but then you're going to refine them over time and say, okay, so now what's practical from a sales perspective? If we were to do that, what would it take for us to get there from a cost perspective? And then while the cost centers are focused on putting together the budget there, your sales leader and you can sit down and say, what does it take, from a cost perspective, do you think, to get there? They're not going to know for certain, but they're going to have an idea of what it's going to take from a cost perspective, which is also going to be kind of a resource perspective. So if they say we're going to grow by 500% next year, okay, how realistic is that with our current structure in place?
Mhm.
Well, we'd have to do a lot. We'd have to do a lot of things on that side. So maybe that's not as relevant. So on the sales side, okay, let's come back down to more realistic terms. Why do we think we could grow 500%? Is that even possible with our current market, with our current product, with innovations we've been making or competitive advantages that we have? And let's get to a second number here. Okay, bring the whole team together. This is our second number from a sales perspective. This is our second number from a cost perspective. All right, this is where we would sit in a more conservative light. Now that we've got a pretty good beat on this, let's go back to third time and think through, what is our final number going to be to achieve these revenue goals with this cost structure in place, and give them that third opportunity to revisit their assessments. And then the third meeting is bringing it all together into a final budget, so that your sales team understands the effort and the cost it's going to take to deliver that outcome. And the cost center folks, they're going to be able to understand what their spend is looking to support, so that they are in alignment with the timing of their spend. They're not going to outspend before that revenue has started to come in. If there's a significant initiative that's supposed to start in the in the first half of the year, and it's going to be triggered by reaching a certain threshold in revenue, well, you don't want to start spending the money until you can start to see that threshold is going to be close to being hit. So you're going to hold off on that spend until the sales are at an appropriate level, where you start to see that, whatever kicker it is that causes the spend to be justifiable. So I think that's a good approach to a budgeting process for the year. But all in all, it's just about bringing transparency and awareness to the budgeting process for all leaders of the company.
I like this approach where it's not just a one and done. Here's the spreadsheet. Here's what it is. It's collaborative over time. So you can go away, think about it, look at your numbers, come back and adjust. Say the budget's set, right? You're ready. How can the team go into the next year and not just have it be a set and forget? Why is set and forget so dangerous for an annual budget?
Yeah, again, back to the by bringing in the full team in on the budgeting process, you have a certain level of awareness that goes along with spend. Again, back to the three horses and EOS speak and making sure sales, ops, and F&A are all getting to the finish line at the same time. Your ops team needs to be evaluating how sales is performing before they go out and spend the money and hire additional producers or account managers or customer service folks. Otherwise, you're going to be, in a bloated department somewhere with excess capacity, and it could be detrimental to the team and most certainly detrimental to the bottom line. And then from the sales side, having that communication with operations to say, hey, we're about to land a really big contract or a really big sale. We need to start preparing for that. And we had budgeted for this last year. We thought it was going to be here, Q2. Well, it's actually going to be here in Q1. So we need to, look at what we had budgeted for the additional resources to hire sooner rather than later. And obviously the costs will go up, but there's a good business reason for it. But if you just set it and forget it, the operations team may not be notified by the sales team until, it's too late and that customer's already there and they're being underserved. So I think that it's important to review not just the quantitative, not just the numbers on a monthly basis, but what kind of activities happened in the last month that are going to be a trigger for either sales to be more aware of something happening in operations, or operations needing to be more aware of what's happening in sales to make sure that not just the money is being spent correctly, but also at the right time.
Many founders are used to working with an accountant at, once a year. What would be the difference if they brought somebody in, a CPA or fractional CFO, earlier and had that person work as a partner in this process, this budgeting process?
That's a great question, Chelsey. I was actually speaking with a fellow entrepreneur this morning, and he was a former partner of a CPA firm. One thing that we were talking about this morning is that when a business owner looks at a CPA in that once a year mindset, the CPA is also thinking about, just from a compliance mindset, how they're serving the client. Because at that point, that's all that they are, valued for. And they're not going to necessarily have an easy road ahead to oversell the clients from the client's perspective on the value of looking at next year or a planning and strategy perspective. I think it's really important that business owners, business leaders consider that having a CPA consultant, in your business can help you set up strategies for next year. They've got just a strong understanding and awareness of not just finances, but also business concepts, and can be a great sounding board for ideas. It's not necessarily just, a cost center, like you would have to pay a tax accountant to have your tax returns done, but it can be a very strong investment center, investing in that knowledge and that expertise to help set up a structure, help set up proper reporting, accountabilities that can yield a strong return from other areas in the company that you didn't even think about. Could be efficiencies with people. It could be efficiencies with your budget spend, and the couple bucks that you'll pay extra for having that CPA there throughout the year may yield significantly more than you're spending to have that person there. So, I think it's important that both businesses and CPAs out there don't just look at a relationship as a transactional, compliance once a year tax or audit, that we really look to help each other as strategic partners, because at the end of the day, that CPA is going to be helping facilitate the financial results that a annual attest engagement like an audit or a review or a tax return is going to need. So at a minimum, at least, hopefully those bills are now going to be less expensive by having somebody in there throughout the year to make sure the numbers are correct.
If you're on the leadership team, how do you choose the right type of financial partner to help you with planning and not just taxes? How do you find the right fit for your team?
Yeah, I mean, the right fit, I would say, is very subjective. So From my perspective, most CPAs are very aware of how businesses operate. Our CPA credentials come with an extensive amount of education and testing around multiple concepts beyond just tax and audit. And we've been certified to help businesses in this way. And I think that it comes down to a bit of a personality and trust, match. There's a little bit of an experience requirement, but at the end of the day, I think just CPAs have such a broad understanding that they can adapt to a lot of situations and industries to help businesses of any kind and any size, given enough time and autonomy to do that. I think that it's important to, like any hire, to be able to hire people that you trust, but also are of a different perspective than you might have. Most business owners don't start their business to be a finance leader. That's what finance leaders are good at. So give them the trust to be good at that. And I think you'd be pleasantly surprised to see how much stress comes off your plate by leaving that skill set for them to leave that task or that project for them to handle, since they're the ones that are actually, started their career to be good at that. And, I think that kind of awareness that, as an entrepreneur, we want to do everything and see everything, but there's people who are better suited to do certain things. So I would say, trust a finance expert as your first step. And then, I would obviously advocate for a CPA to look at your finances and be a strategic financial leader, as opposed to a non-CPA, just given the credential and everything that they did to learn and the care that they put into it and the professional approach that they take and the ethics behind the license. So I think it's more so about the person that's decided to go that path that will help show up for you more.
I feel like having somebody come in part-time, because the end of the year seems like a mad dash for a lot of department heads. It's just like we're trying to meet our goals. We're trying to put the budget together. We're trying to figure out what next year's going to be like, plus all these holidays, what's going on. So having somebody come in part-time to be a sounding board or to poke holes and find blind spots seems like a fun idea. How would someone from Wave CPAs or a fractional CPA or fractional CFO help a business who feels overwhelmed this time of year?
Chelsey, you and I were just talking about something similar a little while ago. There are things in your podcast process that it takes you significantly longer to do. You can do them, but you're just not as quick as someone else is. And for me, there are things that I am slower at as well that I wish I had someone else to do. And so I go out and find someone else to do those things that I'm not as good at, because my time is more valuable spent on things that I'm good at doing. I'm going to be more effective and be able to have a bigger impact by hiring someone to do the things I'm not good at. So, if you've got a team member who is really good at, I don't know, Excel formulas, but they're not really, necessarily good at analyzing that information, you've got to have the balance there. You've got to have someone that can do the formulas and someone that can analyze the results. And they're not always going to be the same person. So, if you're a leader, again, you're selling a great product or a great service that that you're passionate about. It doesn't necessarily mean you have to be good at finances. And so, if you bring in a fractional person, if you bring in someone who's got that experience and that, if they have a CPA license, they're probably going to be, pretty knowledgeable on finance. You're going to get most likely somebody who's going to be more efficient than you. And of course, you could have that person in your team that's doing the formulas in Excel. They could have them analyze that information, and they may do an okay job at it, but they may not be doing it as fast as someone else who could be doing it. And you might be freeing up that individual in your company to do more value-added tasks. And that fractional can come in and do the things that the company doesn't need a full-time role for, but definitely needs it to be done quickly, and they can produce the quick results. So it's not always just a trade-off of time, but it's a trade-off of the ability to get something done faster than someone else in your company. I think that a fractional CPA can definitely, or a fractional CFO can definitely deliver on that. It's just a matter of, getting that right match in place.
I've found that having folks come from the outside in to help a business can also blunt the emotion or take the emotion out of some of the decisions. Like, hey, you should do this because here are the numbers, not this bias. Like you sunk 30,000 hours into doing it this year, so it's going to be a success next year. How can founders keep emotion out of forecasting and budgeting and focus on what the numbers are actually saying?
That's a great question. I mean, that's an example of where what you're asking is a very personal matter for founders and business leaders. It's a lot of pride on the line, and it's almost unfair to have a subordinate challenge you and expect that they would challenge you on something you're so passionate about, and could ultimately hurt the relationship between an employer and employee. Having an independent fractional CPA come in and give you that feedback can be the unbiased approach and the honest approach that you need to get another opinion that's truly authentic and without, fear of being reprimanded for giving honest feedback to an owner of a company, which obviously it happens. And, you're going to get, I think, a more pragmatic approach, and one that can truly help the company move forward in ways that maybe it hasn't before. The Marcusism, as I've been told, I have a lot of, is if you do the same thing you've always done, you'll always be where you've always been. Same way, if you have the same perspective year over year with the same team, you may be limiting yourself on the growth that you can have.
Are there any trends or shifts like AI, labor shifts, customer behavior changing? Are there any trends you're seeing that can affect how budgets are being put together this year?
If I'm speaking to a large segment of the country here, I think there's a lot of technologies out there that could be leveraged at small and medium sized businesses that are not being implemented or effectively utilized. I think, I'm speaking for myself and probably some other CPAs I know. We understand how to look at processes, inquire and ask good questions, and find a better way, a more efficient way than doing the same thing you've always done in an organization. And by leveraging technology, even if you have to pay for a subscription fee, you might be getting substantially more time back in that person's schedule to do a lot more. So I would say that having an outside perspective for next year to look at technologies, the correct technologies, I wouldn't say you just need to Google or ChatGPT a technology that's going to help your company, because it's a little bit more intimate than that. You want to have a good understanding, and this is where a fractional CPA can come in and ask good questions and help you source the right technology for your company, so that you're not just being oversold by a technology salesperson on a product. You're getting something sold to you that is going to be an optimal and truly help your company cut costs and help your people do more value added tasks, but also help them and giving them more a sense of, valuable contribution to the company. I think those are important things to consider.
When you're budgeting, it's also a great time to look at the tech you're already paying for and audit across departments. So, hey, what does your widget do over here? What does your widget do over here? So you don't buy more tech next year if you don't need to. Or you could even downsize and merge into one tech that, three departments are using three different things. They all could be doing the same thing. I've seen that be really eye opening when you look at what everyone's been paying for the full year.
Yeah, and if you've got a dynamic budget process set up, you're going to have all your software costs pulled into the same P&L line. And if they're itemized and you're asking good questions, you're going to find out that software A and software F are very similar. And the only difference between software A and F is, one or two things that could be done in Excel, and they're not adding a ton of value to do in the software. You might be cutting your software subscription by a large chunk of money and, just use Excel for the feature difference there. And, that's a one way to consider, how someone looks at the overall budget and asks those good questions from an outside lens, as opposed to being in the business all the time. And, if you're able to find, cost spends like that for your next year budget, there's a theory out there that if you can find 5% reduction in those cost spends, it's equivalent to adding about 30% in additional sales next year.
Wow. If a founder's heading into 2026 planning, say next week, as we wrap up, what's the first thing or first piece of advice you'd give them to do?
I think you want to look at your people first and foremost. We talk about, different ways you can spend money and different, revenue you can make, but your people make the company grow. The people make the company money. That your people protect your spend. And if they're going to be doing all those things for you as a business owner or business leader, you should be looking to make sure that they're being taken care of as well. I think the more you give out, the more you get back. So making sure that their job structure is in a way that makes sense for them and for the company, making sure their compensation is fair and allows them to achieve their goals outside of the company is definitely important. And I think if you lean into that, you're going to have a better results for the rest of the budgeting process and the rest of the forecasting for next year. And hopefully that results in a better financial performance for the company for years to come.
I appreciate you coming on and giving very practical, like, hey, do this. Here's what's worked advice for folks who are either founders or leaders who are in charge of a certain part of the budget. So appreciate you sharing all this with us today.
Absolutely, Chelsey. It was my pleasure to spend this time with you. And anyone listening, please feel free to reach out. I'm definitely happy to have more specific one-on-one conversations that apply to your situations and definitely connect you to a wide array of CPA consultants on our platform.
Perfect. We'll link how to get in touch with Marcus and how to find Waves CPAs below. Thanks so much.
Thanks, Chelsey. Have a great day.